So what is the debt to income ratio and why should you care? Welcome back, cash flowers. My name is Matthew. I'm the president of VIP Financial Education. We help you go further, faster financially. Glad to have you here on the channel. Consider subscribing. Now in today's video, I wanted to share with you guys a very important topic. I receive a lot of questions about this. So in this video, it's gonna be all about the debt to income ratio, baby. Now, what is it? How do you calculate yours? Why should you care so much about it? Why is it so important to you? So I've had many discussions with coaching members as well as students here on the channel about this specific ratio that, quite frankly, I don't think gets enough attention from people who are really in the process of concerning themselves with their credit profiles. So without further ado, your debt to income ratio is exactly how much of your current income is used to service balances on your debts. Another way to look at this debt to income ratio is that it tells the banks how much money you really have to play with and directly affects your net cash flow position. Now, I define cash flow here as the monetary difference between what is earned and what's being spent. And this dollar amount can be either a positive number or a negative number depending on the income and expenses that are considered. Now, with the debt to income ratio, it's represented by a percentage that's used by the banks and the financial institutions that make it easy for them to see if you would be a good credit risk or not when in consideration for a loan. Now, this is calculated by dividing your monthly liabilities into your total adjusted monthly gross income, which gives the debt to income ratio. For example, if your total monthly debt servicing costs, including debt servicing on things like credit cards, auto loans, mortgages, etc., is $5,000, and your monthly income is $10,000, then your debt to income ratio is 50%. So let's take a look at the standards that financial institutions are looking for as either favorable, could improve, or need to take action. Obviously, the lower the ratio, the better you are at managing your debt to income. Therefore, the 50% debt to income calculated earlier, anything above that would definitely be in the category needing to take action to bring that ratio down in order to look more favorable to any lending institutions. In other words, with more than half of your income going towards just debt payments, you may not have much money to save, spend, or handle unforeseen expenses, which is why lenders may actually limit your borrowing options. Now, if you fall into a range of 36% to 49% for your debt to income ratio, then you do have some opportunity to improve. Even though you are managing your debt adequately in order to get many loans, you may want to consider working towards lowering that number. Now, this could put you in a better position to handle unforeseen expenses, and if you're looking to acquire more debt weapons, keep in mind that lenders may ask you for additional eligibility criteria. This is not considered then a compensating factor for you. But if you're in the 35% or lower range, then you definitely are looking great relative to your income. Your debt is at a manageable level. And in other words, obviously you're going to be more likely to have money left over for saving or for spending after you've paid your bills, which is why lenders are generally going to be viewing that lower debt to income ratio as favorable in terms of building a low credit risk. All right, now I just went over a basic example of debt to income ratio. Are you with me so far? I imagine you are. So far, pretty easy. Now let's go ahead and discuss the second debt to income ratio that you're going to want to be aware of that lenders use, especially if you're looking to secure a mortgage loan. The one example I just used is called the back end debt to income ratio, but for some banks and lenders, they do require another calculation called the front end debt to income ratio to evaluate your risk for financial institutions. Now, this second calculation takes into account what your new proposed monthly housing payment would be, including the mortgage, the insurance, and the taxes. So your full PITI payment, that's the acronym, principal, interest, taxes, and insurance. Using the example of $10,000 a month income with $5,000 in monthly liabilities that we talked about from earlier, and we know the debt to income ratio is 50%, but what if $3,500 of the $5,000 would be a new monthly mortgage payment? That includes, again, the taxes and insurance. Prior to this, only $2,000 out of the $5,000 was spent on the rent, and now you would be increasing the housing costs to $3,500 in this example. Therefore, the front end debt to income ratio would be 35%. Now, you have these two debt to income ratios that lending institutions are generally going to be looking at, whether or not they're deciding to give you a new mortgage loan. But keep in mind that the back end debt to income ratio is more important since it does factor in all of your monthly debts, and it's more of a representation of the risks that you present to a lender. You might be asking yourself next, well, do banks and lending institutions require both numbers to fall under a certain percentage? And the answer is absolutely, they do. So you do have to be aware they're looking at both when looking at giving mortgage loans. Now, if you're enjoying this video, obviously, I do want to continue to put as much educational content out here like this for you. Go ahead and smash that like button for me. It does tell the algorithm that you're enjoying it and that this is valuable. Now, there's a classic rule of thumb for these ratios, folks. It's 28% on the front and 36% on the back, okay? So you shouldn't exceed 28% on just your new housing expense, the new mortgage, on the front end, and the combined shouldn't be beyond 36. So in that example I gave you, you'd be more likely to get rejected at a 35-50 ratio. All hope is not lost though, okay? If you're in this situation, other loan types do have more flexibility. Let's go ahead and start with the FHA loan option for mortgages. If you're granted by the Federal Housing Authority to get an FHA loan, they're generally designed for more low to moderate income borrowers with lower credit scores than many conventional loans. They typically use a debt to income ratio that's of 31% for the front end and 43% for the back end ratio. However, these limits can be even higher depending on the specific lender and if the loan is manually underwritten versus being underwritten through a system that they call desktop underwriter, DU. Now, you do want to check into the details of this, of course, with any lender you might be working with prior to going out making offers and getting under contract to see if they allow any flexibility on your debt to income ratio thresholds. Another popular loan type is conforming loans, and that's through Freddie Mac and Fannie Mae. For example, Fannie Mae has a 36% debt to income ratio maximum, but they will allow up to 45% DTI if you have some factors such as other assets or a larger down payment, or you might have really great credit that could cause them to compensate. Now, with Freddie Mac, you can submit a written explanation that justifies exceeding the 36% maximum, and you might get approved with a higher debt to income ratio for it. Again, you're gonna have to check with them, check with your lender to see all the details and procedures. Another type of loan that allows higher DTIs are VA loans. This is for veterans, with a 41% being the maximum debt to income ratio acceptable in most states. You might even be able to get between 41 and 50 with compensating factors like I mentioned with the FHA loans. Bottom line is this, having the lowest possible DTI will pay dividends when acquiring mortgage loans, auto loans, or other debt weapons discussed here on the channel. But let me leave you guys with some ways to lower your debt to income ratio. You can make extra payments towards specific monthly debts to lower it more quickly. You can avoid taking on more debt by considering to reduce the amount that you charge on credit cards. Try to postpone applying for new types of loans, wait on vehicle acquisitions, and so forth. Lastly, recalculate your debt to income ratio monthly to see if you're making progress, because watching your DTI fall can actually give you all the motivation that you need to accomplish your financial goals. Make sure you stay tuned to the channel. I do give a number of other suggestions as to how you can lower that, either by paycheck parking or even using business-related accounts that don't show up on your credit. And keep in mind that usually debt to income ratios are calculated by what's pulled through a tri-merge credit report when mortgages are being applied for, and any other type of loan that you might be applying for. When they pull your credit, they're going to import that data, and that's how your debt to income ratio is going to be factored. I hope this helps you guys. Again, smash that like button if it does. Leave a comment below. Have you found any great resources online for debt to income ratio calculators that might be able to help do this for you? Love to hear about it. Leave a link in the comments section, and make sure you're subscribed to the channel for more great content here. Look forward to seeing you on the next video, my friends. Until then, make it a great day and keep on cash flowing. Take care. Which is a non-editable page. It's very important to understand that this opening tab will not require you to put any information into these fields. This actually imports the data from the other tabs below. Now, if you've ever used an Excel spreadsheet, you'll navigate the spreadsheet by going to individual pages down here. And it'll start with the revenue and assets page. On this page, you'll want to itemize each individual income that you bring into the household or the business. Now, it's always been my recommendation that you create an individual cash flow cruncher for your businesses, an individual cash flow cruncher for your real estate, and an individual cash flow cruncher for your house.